just want to kind of share a few things with you if you want to go to the next one. So our mission to create the village that every single parent needs. We hope that you find community here. We hope you grow and like meet other people. Go ahead, next one. Get connected. Thursday, so not even a week away, 6 days, is our steering committee. So that's open to any current or former single parents. And that really is our planning meeting where we're talking about like what's coming, what do we want to see, how can we steer this ship, you know, how can we serve single parents like even bigger and better. Next one. We have a lot of groups. All these papers that you see here, we have a single moms group kicking off on the 14th. We have a single dads group kicking off on the 28th. We have Love and Logic, which is a trauma-informed 6-week group starting. We have Financial Peace University is going to start April 1st. And we have the Smart Step Family. So if you're even thinking about dating, or like if your ex is dating, the Smart Step Family is designed for couples that are dating, maybe newlyweds. But when I went through the curriculum before Nick and I got married, I felt like it was stuff that we should have known way before that. Because it walks you through like how your kids might feel, how they might react, how can you help them through that process, all kinds of different things. So lots of things coming. I'm gonna go to the next one. Next month, we're gonna do banking, which sounds a little bit flat, but there's so many programs and things that banks have that can really give you an edge in your finances. Even if you think you're like month to month, paycheck to paycheck, there are some different programs that we want to kind of walk you through and just highlight, because finances is one of the number one stressors for single parents. So, and then we have a whole bunch more content coming. So, connected social media is where you're really going to hear about everything. Next one. So without further ado, Christy, been doing taxes
Since 2009.
Okay, wasn't up for that. But so I was introduced to Christy actually through the executive pastor of Waters. He referred you. He spoke highly of you. So I'm very appreciative that you would come out and speak to our single moms, and we're recording you. So pressure. This is just information that's in your wheelhouse, and you make up part of the village that supports single parents, and so we really appreciate you.
I'm glad to be here and happy to help. I actually hate taxes, so that's a great part about this.
I'm going to let you take it away.
I am Christy, and I am a partner at St. Sovereign Zabla CPA, formerly Sartell Tax and Accounting here in Sartell. I've been doing accounting and taxes since 2009. I graduated from the Minnesota School of Business with my master's degree in business administration, a bachelor's degree in accounting, and an associate's degree in managerial accounting. So one could say I like numbers. As I was saying earlier, I hate taxes. But the reason why I hate taxes is because everybody else hates taxes. When you're dealing with the government and somebody's money, they don't get too happy when you tell them they owe in. So, but I'm here to hopefully help you avoid that. I have 5 children myself, ranging from the ages of 5 to 20. I love to read and just spend time with my family, but as you all know, that's not a lot you can do when you have that many kids or have kids in general. So my job and my hobby is now accounting. So our topic tonight is tax tips for single parents. I hope you get some of your questions answered by this, and that it gives you a little bit more insight on what you're dealing with. I know that taxes can be confusing and scary to complete, to talk about, to deal with. The whole 9 yards isn't fun, especially when they're constantly changing and the wording that the IRS or the Minnesota government gives us isn't clear at all. Half the time it's not clear for us either, so it's a gray area. There are loopholes. Each person reads it differently. I bet if I gave you one paragraph and I gave you the same one, you would not come with the same conclusion. We deal with that every day. So then on top of it, let's add the questions in of, can I claim head of household? Who can claim my kid this year? What should I do if my ex claims the kid and they weren't supposed to? I deal with this all the time. It's not fun, but there are ways around it. So things can get quite messy really quickly. I'm here to hopefully help put your mind at ease a little bit. I am only going to be able to touch the surface of some areas, but if you have questions or want to know something, feel free to send me an email. My contact information was on that first page that I gave you guys for notes. The information I'm going to touch on is very general because everybody's tax situation is way different. One person could have a kid in college, you could be going to college. Everything is different, so I can't really go deep into every single one thing, but I'm going to try to help with the generalized portion of it. You each got the handouts. I'm going to touch base on quite a few of them tonight, but it also gives you a little more numbers to bring home with you, I guess. I'm basing most of my information on the fact that I'm guessing, since it's a single moms group, you're not married. Am I correct? Okay. I left, no? Okay. There is some stuff in here, but just know my numbers might be a little bit different because married filing jointly's numbers are different than head of household or single. So I can get those to you if you need me to, but most of my numbers are based off of head of household or single. First thing I want you to know is the IRS does not care or recognize your divorce decree or your separation maintenance agreement. They don't care. When you tell me there's 50-50 custody for tax purposes, that does not exist. The government looks at who the primary parent is. What's a primary parent, right? The primary parent is a parent, foster parent, guardian, or even sometimes a grandparent that has a child 183 nights of the year or more. Now, the only time that that number does not actually agree is on a leap year. So if, let's say, you really do have 182 nights equally, then we look at which parent makes the most money, because that person is now primary parent. But most of the time they go by whoever the child lives with most. That is the number one thing that they look at. Now, if, let's say, your kids stay with your grandparents while you work at night, those nights are yours. This is for primary parent. And primary parent leads into the head of household, which will come. Did you get my thing? Next. 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 Here we are. Okay, so with the primary parent, what I want you to do, and you're all going to go, I don't need to do this. You need to keep a calendar of your nights. And the reason I say that is I've watched it go from cordial one year where I have them both sitting in my office going, which way is better, to all of a sudden one parent got a boyfriend or a girlfriend, or they didn't like that you got your kid a haircut or you got a phone and you're at odds with each other. Then the war begins. And then we're going, oh, did he file before I filed? Because now I can't claim. And then we get into a lot more legal funness after that. So please keep the calendar, even if you don't think it. Yeah, go for it.
Like my course degree says, who gets to file claim that.
It does. It does. So the IRS does not follow that divorce decree. So when, let's say you're primary parent, I'm going to go with that. You have the child more, because that's normally how it works in Minnesota. But he gets to claim the kid this year. That is still true, even though you are primary parent, but you have to provide him with a Form 8332 in order to do so, which I have coming up. So give me just a second. Primary parent can determine which parent can claim the child tax credit according to the IRS. It can also determine who claims the head of household deduction. If you do not follow your divorce decree or legal agreement, your ex can take you back to family court. So that's where, even though you are primary parent, yes, we still have to follow your divorce decree, but the IRS doesn't care about it. you care about it. The IRS does not. So we have to still legally follow your stuff, but it also changes what documentation you have to provide. And let's say, okay, it is their year to claim the kid, but they're behind on child support. And your divorce decree specifically says if they're in arrears, you get to keep the exemption. Well, that means you don't have to give them the 8332 to file for the kid. You get to keep them. So I say the IRS doesn't matter or doesn't care because it doesn't, but you still don't want to get in legal trouble. So it just changes what documentation you're required to have, especially in a dirty situation where people are fighting with each other.
So the 8332 was given to the IRS?
Yes.
Or to your ex?
You give it to the ex to give to the IRS. Then they could, if they end up claiming the kid when they shouldn't have, and you didn't give them the 8332, they'll get in trouble. So they will actually come back. If, for example, a client of mine went and tried to file her tax return, and the ex, who has not seen the kid in a year, filed before she did. She did not give him the 8332 to do so. The IRS is now going back. You did not file your tax return with the 8332. You are getting penalized for fraud, penalties, and interest for the refund that you didn't get, and you have to pay all that money back. So that 8332 allows them to claim the child, and if they don't have it, that's your first proof that you get to keep the child and that you get to get that exemption. So most of the time with the 8332, if you have a good accountant, they should be asking you these questions. But let's say you file your own. I was going to say, if you file your own and he files his own, but he files before you, he's going to get that exemption. You're going to end up getting a rejection, and then you're going to have to fight with the IRS to give you your stuff. So then that goes into play. Next slide, please. This is kind of a recap of what we had just said. Next one, please. Required documentation. So when you're trying to provide the IRS with, hey, I get to claim my child, you have to provide a birth certificate, you have to provide a social security number, and then you have to provide proof of residency. That is a school or a daycare report with your child's name and your address proving that they live with you primarily. Or medical records, SNAP benefits, medical assistance, daycare assistance. As long as the kid's name is on it with your address proving that you're primary parent, that exemption is yours. Next slide, please. So this is a Form 8332 that is in your packet. This form, whoever is primary parent is supposed to give the non-primary parent this form. Now, inside of this form, it asks which tax year that you're giving it to. So that means you can tell them, I want to give them, it's supposed to be every other year, so this year you claim them, you don't give him this. But then next year, you put 2026, and then it's every other year, 2028, 2030. Please don't do that, though. Because again, if he's in arrears, or your partner is in arrears, and you already gave this exemption, they get to claim it because you signed it already. So please only do this in the years that they give it to you. And if it is truly a 50-50 custody scenario and your divorce decree says they get to claim head of household and the child tax exemption the following year, then they have to give you this form for you to claim it. It's not fun. This has been more pushed by the IRS recently because of one, fraud. Children's names are being claimed as primary names on Social Security. And then because we've had tons of people where the other parent that has no contact claims the children. Well, now that they require us to PDF attach this to the tax return, it should reduce on that information, or at least allow the people that are supposed to get it much quicker because of these forms. Any questions on the form themselves? You're kind of giving me this, I don't like this look.
I've been doing my own taxes for the last 7 years. I've never heard of this or done it or anything. I've never had any issues. So like,
Are you very cordial with your partner or ex-partner?
Same with hers. He gets to claim the oldest one. I get to claim the youngest one, and that's what we've done.
And
I mean, we have primary and all that stuff. I guess I've always claimed head of household. Whether I should do that or not, I don't know. I just thought it's because I have her. She's my claim. I'm the head of household at my house. I assume he did the same or whatever.
Okay. So as long as you have the child more than half the time, you are head of household. That is 100% the way it goes. If the divorce decree says,
Technically, primary of both of the kids, but I don't think I can claim head of household.
head of household, it all depends on what your divorce decree says on whether you guys want to get into that fight or not. But the IRS doesn't care. You're head of household of both. And if he can't prove that he's paying over half of the support of a child, then no, he shouldn't be claiming head of household. And that's what this is supposed to prevent is it checks. Okay, he's not primary parent. He has a 8332. He shouldn't claim head of household. And without this form, he shouldn't get to claim the child. But you should give him this form if it is in your divorce decree, because you could go back to family court and get a kick in the bum. So, well, and then these honestly haven't been a huge thing until the last 3 to 4 years when we have seen an uptick in issues and fighting with the IRS. And so now I would say it was last year that they started requiring us to attach these. So, and that's just it. If you file by yourself, you wouldn't know that information, and either would they, and that's how people get away with filing first. And then you have to go through 4 to 12 months of fighting with the IRS to get your refund because they already claimed it.
So I just had a question before.
Yep.
It's like 50-50 like that, so like, and we agree, like, you know, because it says like, so then do we switch this form, like I sign it for him?
Correct. So the question is if it's truly 50-50 where one parent gets the head of household and deduction 1 year, and then the other parent gets it, each should give the 8332 in their respective years. So in the year he claims them, you give it to them, and in the year you claim him, they give it to you. So yes, that is correct. You might have to remind me to do that a lot, just as a
I
warning.
mean, I think you answered it in a way that makes sense.
Okay.
Majority of the time, it's that one I felt like. And it's important enough that I think.
And like I said, this is just coming to light, like where they're very important now, because there is so many non-cordial, everybody's fighting with each other scenarios. Now, let's say you're still married in this situation, but you're separated, then there is no legal agreement on that either. So you have to be separated and living apart from your husband for over 6 months of the year, the last 6 months specifically. So that's where these rules apply if you're still married. Now, my recommendation, like I said, do not sign this for multiple years, because if anything in your life changes, you don't want this to be under your thought process. Any other questions on the 8332 or claiming the child? Next, filing statuses. So this is kind of where that primary parent really comes into play as well for the head of household. So we have the 4 different filing statuses: single, head of household, married filing separately, and married filing jointly. For the purpose of the single moms group, we're going to focus on just single and head of household. And the head of household is our primary thing that the primary parent designates. So if the child is with you 183 days of the year or more, you are qualified for head of household. Honestly, in the IRS's eyes, that is why the divorce decrees don't matter, because you are primary parent, head of household. So that is where the divorce decrees get kind of sticky, because if you're primary parent, they shouldn't be qualifying for head of household. So your divorce decree is actually against the IRS regulations if it says you go back and forth and the custody is not actually 50-50. They're not living with you 50-50. So that's something to keep in mind if you're in the mood to go back to court and be like, no, I qualify for head of household because I have them 51% of the time, the entire time, then you should be able to claim head of household all year. So that's where I do kind of, primary parent is important, because even though your divorce decree says one thing, if you're head of household, you should be able to keep head of household. And under the IRS, you could, but whether you want to fight that battle with your family court, that's on you. Tax preparing wise, you deserve the head of household status. Now, head of household status is unmarried, legally separated, or have lived apart from your spouse for the last 6 months of the year. So May 31st through the end of the year, you can claim head of household even if you're still married, as long as you haven't lived with your husband. You also have to pay more than half the cost of keeping up a household. So that's rent or mortgage interest, property taxes, food. It does not include clothes or education. So it doesn't look at that. It's just the household, utilities, stuff like that. No education, no clothes. Daycare is kind of up in the air because it's got its own separate credit. So I also would not include those. I would just look at the living expenses that you provide for the child. And as long as you pay over half those costs, you still qualify for the head of household. And then the other thing that we've already touched base on is being primary parent, having the child for over 183 nights in the year. Now, side note on that too, let's say you guys didn't split until September of the year. Well, they only take in the remainder of the year for the nights. So from September to December, who had the most nights from that time period is how you qualify for head of household or primary parent. Single, so let's say you aren't head of household, you don't meet those bills, then you're the single one and your standard deduction is $15,750. Head of household, why that's so important, why you want it so bad, is your standard deduction is so much higher being head of household. Married filing jointly, don't quote me on this, but it's over $30,000 is your standard deduction, somewhere around that. I don't keep those numbers on my head because there's way too many to keep in my head, and that would be horrible. So standard deduction is the automatic deduction they give any person that files taxes. So when you're looking at, you have your gross W-2 income, then you get to minus out your standard deduction or your itemized deduction. Standard deduction is just the number the government gives you to be able to take off of your income. Itemized deductions are things such as medical, dental, vision, mortgage interest, property taxes, car tabs, charity, gambling losses up to gambling winnings, lawyer fees if it produces taxable income. And I do have a slide on that just so nobody has to write that one down. So most people take standard deduction nowadays because it's so much larger than what they can get itemized. There has been a couple of changes starting to come forward in 2025 where some more people may qualify to itemize, but it's going to be very up and down. We don't really have the statistics on that one until we file this year. I can tell you right now, out of the 2,200 that my partner and I do a year, we only have about 50 that actually itemize. So it's very low. Any other questions on that?
What's the age of the child?
There's two answers to that. 18 for high school, and if they go to college, it's under 24, so 23. And I will have some more information on that too, but that was a good question. Let's kind of look at some deductions because I know that's what most people are looking for. So next slide for me, please. We're going to start out with deductions revolving around having children first. So first off, we're going to start with the child tax credit. Now there's two different child tax credits. Federal and Minnesota have separate credits. Federal, in the year of 2025, for any child under the age of 17, so 16 and under, the child tax credit is $2,200. For anybody 17 to 23 that are in school, that credit reduces down to $500. Yay, fun, they're most expensive and you get the least credit for them. It's not great. Phase out begins for somebody with head of household or single status. That starts to phase out at $200,000. So high income earners lose the amount of child tax credit they can have. $50 for every $1,000 that is above $200,000. For married filing jointly, I'm pretty sure it's doubled, so I think it's $400,000. Next slide. Wait, don't. Child tax credit for Minnesota. You'll notice in parentheses I have on federal that's only partially refundable. That's because only $1,700 of that credit is refundable on federal, whereas for Minnesota, the entire credit is refundable. But for Minnesota, the credit is only $1,750 per child, and it's under the age of 18, so 17 and under. Income limitations are a bit more complex, and they start at $31,950. So it's not very high where they start to phase these out. Next slide, please. These are the phase out limits, and you can see married filing jointly and non-married filers. So that's head of household, single. Once you hit these limits, those child tax credits go away for Minnesota. Also with Minnesota, you can elect to get those child tax credits, a portion of them early. Please do not do that. You're going to hate your life if you do it, because then you have to reconcile it at the end of the year and hope that you didn't take too much and now have to pay it back. So just wait till the end of the year to let the tax return calculate what you get. Next slide, please. The next one that I want to touch base on is the dependent care credit, so AKA daycare credit. This credit is a percentage based off of your income. So the lower your income is, you can get up to 50% of your daycare as a credit. The higher your income, it drops down to 20%. And you only get that on up to $3,000 of expenses for one child and $6,000 for two. It doesn't go up anymore if you have more children than that. And if those expenses are paid by a flex spending account through your work, they don't count on your tax return. And you'll know you have to sign up for the flex daycare right away before the beginning of the year, and you usually can't change it throughout the year. And it'll be on your W-2 in box 10 on how much you did. So they should reconcile each other out at the end of the year depending on your software, but just something you want to keep in mind, like you can't claim a daycare credit and flex spending. It doesn't work. Unless you have 2 or more kids, because the flex spending limit is capped at $5,000, so then you get $1,000 at 20%. So it's only like a $200 credit at that point in time. The other thing is, if you have access to flex spending, I suggest you do it. Because not on this one, it's just a credit for what you've spent. But you've already paid Social Security tax of 6.2% on that money and Medicare tax of 1.45%. So if you flex that money, not only do you save your federal and state taxes, but you also save 6.2% and 1.45% on top of that. So if you have that option, I do suggest using it. If you don't, go ahead.
That's the one that you have.
Correct. Correct. So if you only use it, let's say for school purposes, make sure you're calculating out, all right, kid stop is $30 a day for my 3 kids times by 5 days a week. And just make sure you're trying to calculate it out. Because yeah, if you don't use it, you lose it. And then you pay a penalty for not using it. So that's kind of, and I don't have this in here, but that's the same thing if you have FSA as opposed to HSA. If you don't use it by the end of the year, you lose it. So keep that in mind too. Any questions on the daycare credit?
Is it, can you just credit versus?
So a credit is a dollar for dollar take off of your tax, whereas a deduction is just reducing your income. So let's say you have $1,000 and you get a $500 deduction. It drops your taxable income down to $500, and that's still subject to your tax rate. Whereas if you have the $1,000 and you multiply that by your tax rate, and then you have a $500 credit, it comes off of whatever the tax was on your full income. So usually credits are better, but they're almost always way more limited than a deduction is. K through 12 education subtraction or credit. That is in one of those pamphlets that I also gave you. This is not a huge deduction. It's really not. But when you're looking at every dollar that matters, it can help out. It allows you to take pens, pencils, notebooks, 1 pair of gym shoes, 1 pair of gym clothes. And the fun part is a performing arts deduction. If your child is in dance or theater or boys choir, band, there are deductions for all of those as well. Dance is very tricky. You can only take tuition. You cannot take the performance fees or the outfits. So that one you can't do, but you get the deduction for the tuition. This counts for homeschooling, private schooling, public schooling. You get deductions for all of it. So there is specifics in that pamphlet that I handed out. It does not include backpacks, tissues, food, Kleenexes, the wipes that they make you use for your kids. They don't include that either. If you have to pay for busing, you can take that, but you cannot take gas for driving your own kids to school. There's no driver's ed. That's the main majority of those ones. So, like I said, it doesn't help a whole lot, but it gives you a little bit more of deduction on Minnesota. Next. It didn't send you all of my slides then. That's awesome. I'm going to have to grab my computer here before I finish, but I'll try to keep going here for a little bit. College credits. Oop, nope, we're going to go. Earned income credit, which is a credit for people that are middle or lower income levels. This was a very big one. I'll have to pull it up here in a minute. Earned income credit is only for people that have earned income. It cannot be Social Security, pensions, interest, stocks, none of that. It's only if you have W-2 or self-employment income. The credit depends on income and number of children, which I had on a slide, so I will try to get that up here before we leave. I believe it phases out at 61,000 is where it was at for 3 kids, around 54 for 2 kids, 49 for 1 kid, and then it drops to 19,000 if you have no kids. So there's a little bit of a window leeway in there. That credit is 100% fully refundable. So if you qualify for it and you have no tax, you get that back. That's usually how people get such a large refund when they're a single parent, is earned income credits. College credits, kind of talking about what we had discussed, and as well as having children that are going to college. For the first 4 tax years that somebody is in college, you can qualify for the American Opportunity Credit. The first $2,000 of tuition are 100% a credit, and then it's 25% on the next 2,000. So the total credit is 2,500 on that. You cannot have used 529 money. You cannot have used scholarship money. You cannot have used grant money, or if your employer pays for it, it has to be money taken out either in loans or you paid personally.
Is this for parent college or is this for kid college or both?
Both. And with that, so for child college, again, it looks at head of household, because if you're claiming the kid lives with you all the time, you get to claim those college credits. However, if your income is over 160, it's 160,000 for married, so I'll have to give you the single number or head of household number because it's lower. If your income is over that, that credit is reduced, and then you might want to discuss talking about whether the child can claim it or you can claim it. You can look at which is better. So that's what we do in our office, is we look at both scenarios and go, all right, it's better for the kid to claim it, but I lose this amount, so then we can net it out, or vice versa. Like if the kid doesn't claim it and they lose out on a bunch of money, but you get a huge credit. I have a lot of people that like to see which way is better. So that is a big thing. We also have a way, woohoo! Sorry, I get excited. Go on, okay. I'm gonna just kind of pass through. This is the earned income credit one. Next slide. There's the college credit one. Lifetime learning credit is after the 4 years, you get 20% on the first $4,000. Keep in mind, this does not include room and board or meal plans. Next slide. 529 plan. Minnesota allows you to take a subtraction or a credit on 529 plans, but federal does not. The subtraction max deduction is $1,500. It all depends on what your income bracket is, on which is better, and the software that you use should tell you that. The credit is 50% of your total contributions with a max credit of $250. 529 plans are great tools if you're looking at saving for your kiddos, because you can put as little as $25 in or an unlimited amount of money to put in, and then it grows and it's tax-free as long as you use it for education. As well as, let's say kiddo doesn't go to college, you can transfer it to the next child, or you can even eventually transfer it into an IRA for them. So that's that one.
How would that work if, let's just say I got a 529 plan for my oldest daughter, my ex-lady is my oldest daughter, do I still get that tax deduction if I'm not paying her?
Correct. You just have, because it just asks you what the trustee is, the account number, and the amount. It doesn't have to say who it's for, because you could put a 529 in for yourself. You could put it in for your grandpa. Doesn't matter. Any bank will do it for you, or you go on to Minnesota 529 plan, I think is what it's called. You can just search it up and they'll set it up for you. Next slide. These are not related to children, so I'll just quickly go through this. There's a new tips deduction. If anybody works in restaurants or hair places, you can take a $25,000 tips deduction. There are limitations of the $150,000 in income, and they must be reported on a W-2 or on self-reported as income on a 4137. Overtime deduction. This one gets tricky, guys. It's up to $12,500. Again, phase out. But it's only on the amount that's paid over your regular rate. So my example shows your normal pay is $15. The OT is only the half portion, the 7.5. It's not the regular hourly rate plus. It's just the half portion. And they have to give you a paper stating what it is. They've recently came out and said that they're going to allow the last pay stub to count for that, but previously they weren't going to. Next slide. These are all those itemized deductions I was talking about. The main thing that I wanted to touch on here is everybody comes to me and goes, well, I paid $7,000 for my kid's ortho. It doesn't really help because your medical deductions have to be over 7.5 of your adjusted gross income, which is your gross income minus like the tips deductions and the overtime deduction. And then you multiply that by 7.5%. So whatever is above that amount goes towards your itemized deductions. Well, in your itemized deductions or standard deduction for head of household was $24,000 around. So all your deductions have to equal up to over $24,000 before they begin to help. So most of the time they do not count. The only time I have ever seen them count is if you're dying and are in a nursing home or assisted living. Those are a time that I've seen them. But other than that, medical rarely helps you out. And that does include dental, vision, prescriptions, mortgage interest, property taxes, tabs only on the registration tax over the $35 base fee, gambling losses up to the amount you claim gambling winnings on your 1040, legal fees only in the extent that they produce taxable income. And what that means is, let's say you sued a job for unlawful firing and you got a settlement, but you had to pay a lawyer fee to do it. Those fees are deductible. But if it's just to get out of a dispute on property land and you didn't get any income, those are no longer deductible.
All the family law stuff does not apply.
Correct. Correct. Next. Charitable deductions. Inside your packet, I gave you a non-cash value sheet. Again, these all go to the itemization rules as of 2025. So most of the time it does not matter. But for Minnesota, anything over the $500, they give you a 50% deduction on. But this is only on Minnesota. Next year, however, the law changed and you get to claim up to $1,000 deduction right on the front of your 1040. But everything else goes to your adjusted gross income and is subject to a 0.5% floor limit, just like the medical 7.5 deduction. So at least they're upping it a little bit, but it's not going to help a whole heck of a lot, but it gives you a little bit. And that one is only on cash contributions, so cash and check. That is not on your Goodwill, Savers, anything like that. Next. Renter's credit. Please make sure on your renter's credit that they put the electronic filing number on it, or you will not be able to claim your renter's credit. That is now on your Minnesota tax return. It is not a separate filing. So that is the main thing on that one. Property. Oop, go ahead.
Question about the
Yep.
certificate of rent pay. I just learned from a landlord that once my daughter turns 18, she gets to claim half of my CRP. Is that true? Even though
That
she's
is
paying
true.
for it? There's no loophole around that?
Not in the state of Minnesota. And so the really hard part about that one too is
What if my ex claims her?
doesn't matter because this it just gets lost. So the question was, what if the rent is split once the child turns 18, what happens to it? And unfortunately, unless the child files taxes, that credit just goes bye-bye. And
She's not paying for it, I am.
I know. That's been the hardest part that we've had to try to combat, and we haven't found a way around it. Because it's the new Minnesota law that anybody over the age of 18 in a household gets the CRP. And it divides out the rent equally. Correct. And what really, really, really stinks about it is so let's say that 18-year-old doesn't go to college and they make over $4,400 in the year and you can't claim them anymore. You don't even get the deduction off of your renter's credit for the dependent to get more of your renter's credit. And you have to include her income on your renter's credit.
Even if dad claims.
Yes, even if dad claims her because she lives in your home. It's been lovely fun to try to fight with the Minnesota government on that one. Property taxes, you have to live in the house as of January 2nd of the following year. So for 2025, you have to have lived in the house as of January 2nd of 2026. And those property tax refunds are based off of the 2026 property tax statement. So they cannot be filed until after that receipt of statement, and they are due August 15th. There is specialty refunds for people that their property taxes went up by over 12% and over $100. Next. Yay, that's where I was. So again, this is just general, broad information. So if you have questions, feel free to send me an email, or if you want to consult, let me know. I know most people do it by TurboTax, and I totally understand why. But if you have a complex situation, please seek tax professional advice, because fighting the IRS is very hard to do on your own. As well as education credits. We know how to add a certain amount of the scholarships into income so you can get the full credits, where the TurboTax or the H&R Block will not know how to do that. They're just going to net it out and it'll be gone. So just kind of keep that in mind if you have a harder scenario.
How far back can we go?
They open up 3 years right away. And if they find something that they don't like, they go to 7. And if they open up fraud or find that you're doing something they think is fraud, they open up 10. If they confirm fraud, it's a lifetime. For having me. If you guys have any questions, please let me know, reach out. I'd be happy to help. Taxes aren't fun, and I know they're not anybody's cup of tea, but I am here to help. So thank you.